Okay, recording this video. It's actually Monday morning, 2nd of May 2011, Sydney time, Sunday afternoon US time. Hope you're enjoying your weekend. And struggling a little bit to record this video this weekend. Sometimes I feel as if I really don't have very much to contribute, but I'll kind of press on. There's something that's kind of point I just want to make during this video, and so hopefully I'll get to that. Just looking at my charts, first of all, recap on Friday. I'll tag on my day trades. Actually ended up ahead on Friday, but down for the week, down 1 point for the week. Pretty poor week, 2 poor days and 2 okay days, but it's just out of sync with this last move. You can see it on the daily chart here. I'm just looking at this thinking this is going to be an island reversal as we kind of sprint to new highs, kind of left this kind of gap period behind, and I'm totally out of sync with everything that's going on, all the commentary and so on, and everybody's talking about the money supply being kind of pumped up, and prices will keep on going in order to follow what's going on with the Fed and so on. And frankly, I don't get it. We have to reach some kind of exhaustion point, and just the last move up to me is signs of kind of, it's almost desperation, kind of going into these new highs, extremely light volume, and I'm just looking at this thinking we're going to get an island reversal and kind of go the other way, and so many other markets kind of looking exponential to be. But calling tops, as everybody who kind of listens to my video is an exercise in futility. So you're not going to do that. I'm just going to say I don't like what's going on in the market, and really it has clouded my judgment in the last week, being able to kind of go long, and there were some good long setups that would have worked out nicely, and I just didn't take them because I didn't believe in the move, and that's just poor trading. So that being said, I'll just kind of flip through my charts and just show you something that might be of interest to you that's kind of popped out from my kind of bigger picture analysis. Anyway, so Friday's trade, 1.1 million contracts traded. If we drop down to the sine wave chart, this is at ES contracts, this is the day and night session, been pointing to this, and we're coming up to a second cyclical turn after end of trend. This one kind of printed nicely with a pullback and end of trend, second cyclical turn after end of trend, kind of coming up, and I think we're at an important juncture in the market. If you look at the @es.d, so this is the day session only, the signals aren't quite as pretty on this chart with a pullback. Didn't get kind of an end of trend where we did on the day and night session data. Here kind of overshot this level a bit, had our pullback, but again it's second cyclical turn after a kind of a poor end of trend kind of signal here. Looking at my oscillators, we had the trend oscillator kind of turned down on Friday, so better trend kind of just turned down here. We're kind of overextended on the put-call ratio oscillator, which is kind of very similar to the trend oscillator here. The adjusted trend value on Friday was -40, which means there was kind of net selling kind of going on. A lot of, again, I haven't put up the average trade size chart, but duplicate picture of Thursday. We had extremely high average trade size both on Thursday and Friday, and for me that says kind of professional profit taking at these highs. One of the things I'm doing these days, because the overall kind of conclusion I've reached over the last several months and years almost is just to look at your charts that you're trading with the indicators that you have. Yes, look at multiple time frames. So for example, in my day trading, using 500, 1500, 4500 tip bar charts to get my signals for my day trading, and slightly longer kind of time frames for looking at kind of swing trading setups. But sometimes just looking at multi-markets, looking at external analysis, looking at kind of all the economic indicators and data releases that come out really clouds your judgment. And for example, commitment of traders a year or two ago, I used to live and breathe, but these days I just look at it out of interest and not much more. And even the trend indicators and the trend oscillators type analysis, I find them interesting these days, but I pay far less attention to them. I'm far more concerned about my day-to-day setups, because that's what kind of impacts my day-to-day profitability, rather than kind of having this overall kind of picture view. So that being said, I still look at my multi-market charts. I'm still fascinated what's kind of going on in the big picture. We live in an extraordinary time right now. What's going on in terms of the marketplace and the gamble that the Fed is taking, and the the moves that the governments around the world have taken on, with the amount of debt that they've taken on in Ireland, that taking on the debt of the private banking system and all of these things is mind-blowing. It's like you couldn't even conceived of this 5 or 10 years ago, and so it's extraordinary what's happening. But what I find is having a view on what is happening, whether it's good or bad, what's it going to do to the market up or down, is really hard work. I just don't see that there are all these relationships that help you kind of make good or bad kind of day trading decisions. That being said, I still look at those charts out of pure fascination and interest. What's going on? One of the things that I've done over the last few weeks is just separate out my charts into risk trade on and risk trade off charts. And so on the risk trade on charts, the things that I'm looking at are crude oil, the Aussie dollar, silver, copper, the euro, and gold as the kind of things that all should be going up if everybody's kind of accepting the risk trade, and the Fed's trying to push people into a risk trade, and so all of these markets should start to move up in sync. And then in terms of the risk off trade, the things that you're looking at or I'm looking at is the bond market. So we've got the 5, 10 and 30-year treasury notes and bonds, and then the dollar index being the inverse. And these things should be going down if the risk trade is on, and they should be going up if the risk trade is off. So it's helpful for me to kind of separate those out and look at them all as a group. And so, for example, just running through those quickly, here's crude oil. So this week's activity, we've kind of reached new highs up here with rainbow patterns, no demand, bearish divergence, and an end of trend warning signal here. But in terms of professional bars, the last time we had professional bars, they were kind of buying the lows here into 105 and kind of have moved back up. And the last kind of momentum signal was an exhaustion selling signal down here with bullish divergence. So we need to be seeing some kind of exhaustion buying on the upside to signal a top in crude. So crude is going to find some weakness here, but the uptrend is probably still in place. And then I'd combine that with looking at copper. Copper, I've said over the last few days, is showing pretty weak chart. We had at the beginning of the year the end of trend warning signals, all of these exhaustion patterns here, and blue professional bars kind of at the highs. But then the last move down here into the 14s, amateur Rambo patterns kind of down here. We're coming into a cyclical turn at some point. We've had professional buying here subsequently, so we could find a little bit of support and kind of move back up, but it's the weakest of all these kind of commodity charts. And then looking at the currencies, so we look at the euro. I've talked about this. The euro kind of powered ahead after moving at the making at the beginning of the year. All of these extraordinary kind of exhaustion selling and bottoming patterns. End of trend here, second cyclical turn after end of trend, flush and so on. And this move has continued on without kind of blue professional bars at the highs and without exhaustion buying and so on. And then the Aussie dollar, similar type pattern here. Powered on to 110. We've had exhaustion buying kind of setting this move off, but we've not had pullback and end of trend, and haven't seen blue professional bars up at the highs here. So all of these kind of trends seem to be in place. But so interestingly, the commodity markets, gold and silver, have really turned exponential over the last month. And so here's gold up here where we've had some kind of exhaustion patterns, flush signals, bearish divergence and so on. We've not kind of formed a pullback and end of trend sequence on gold yet, and so it's just this would suggest that we've had some initial kind of exhaustion buying at this point. All the gold bugs though are saying, well, this move is still on, and it's only just getting started. But then just interestingly, it's Sunday evening. The markets kind of open Sunday in the overnight, the pre-open on for Monday morning. And this is silver, which was has been extraordinary over the last couple of weeks, and this thing is down. I mean, we're getting down to almost 20% off from the highs up here. So we're at 43 at the moment. What was the low on this? The low was 42.20, I think, here. So and it's pre-open. It's kind of after hours stuff. It's kind of very low volume stuff. But had all of these blue professional bars kind of coming into 50, which has previously been a resistance area. We've got exhaustion buying and bearish divergence kind of coming into this move. Very difficult to kind of call tops in exponential moves like this. But all of these things are interesting because they have started to move exponentially, and the results of the dollar index being just totally creamed by the Fed, and lack of confidence in what's going on in the Fed. So here's the dollar index for the week down at 73, kind of broke through this end of trend warning signal here. And I was saying I didn't think this was going to hold over the last couple of weeks because it's the inverse pattern of euro, and we had all of these coming into the beginning of the year on the dollar index, all of these exhaustion buying signals here. Second cyclical turn kind of after end of trend type thing. It's the reverse pattern here, flush signals, and we just sold off. But in the last week we have had exhaustion selling at this point, so I think this move's going to start to slow down at least. And then if I look at the commitment of traders, I mean, I don't often have these signals kind of pop up, and what I look for now on commitment of traders is kind of divergent signals using the data for the professionals versus the price activity. So I flip the professional signals upside down, and I'm looking for differences in price activity versus commitment of traders activity. And we had kind of over the last few years on the weekly chart here, you can see 76 as a bottom here, but bullish divergence signals here, and we rally, bearish divergence signals here, and we sell off, bullish divergence. This has been fairly nice, the last kind of couple of sequences. But just be aware, the last move down from 76 to 73, we did have a bullish divergence pattern that kind of popped up over the last couple of weeks here. The amount of professional activity here is kind of not mirroring the price activity, and when you look at this on the higher time frame chart, on a monthly chart, yes, it takes a while sometimes. These signals, bullish and bearish divergence signals, can be extremely early, but just be aware the amount of kind of professional activity in this last move down is not maybe mirroring what we've seen on previous lows, and so this could be an extremely interesting kind of turning point here. One of the markets that I'd look at closely, just because of the my traveling patterns and so on, is the Aussie dollar, and we're just sitting at under 110 versus the US dollar, and it's just been an absolutely extraordinary move over the last couple of months, really. We were down at 95s, kind of down here, professional activity kind of buying into this cyclical pattern, and then we kind of took off the upside. Last kind of professional activity was buying into this dip at 104, and then we kind of took off. But we're losing a little bit of steam and so on, and I suppose looking at these multi-markets and certainly looking at kind of economic numbers is always interesting, but it doesn't. My conclusion over the last 6 months is that all the data that you need to trade is priced in to the chart that you look at, the volume and the price activity that you look at on the E-mini. And more, are there any kind of truly leading indicators that show you what the equities market in the US is going to do kind of overall? And I've looked at, tried to kiss a lot of frogs over the last 6 months, and to be honest, I've not really found anything of any kind of consequence. But I will show you this one chart because I think it's an interesting chart, and it's something I looked at probably about 3 years ago now on a consulting assignment, and it was kind of an interesting relationship that has kind of borne out over the last couple of years, and has been going. It's interesting. I'll show you it. And so let me just pull this up. This is an Excel sheet analysis here, and apologies if this isn't kind of extremely clear, but I'll explain the two lines. First of all, this was some analysis done on some FX, and so this is looking at the Aussie dollar versus the US dollar. The Aussie dollar here is shown since 1992, I think it is. So we've got about 20 years of data here on the Aussie dollar. Aussie dollar is shown versus the US dollar in red, and you can see here the Aussie dollar kind of reached a low down in 2001, 2002 at about 50 cents versus the US dollar, which is extraordinary when you look at it now. We're up at $1.10. So the Aussie dollar in these 10 years has actually doubled in value versus more than doubled in value versus the US dollar. Just extraordinary. So the red line here is the Aussie dollar. And fairly volatile kind of pattern, but we had two kind of major trends kind of selling off into the 2000s and then taking off from the 2000s. The Aussie dollar is strongly led by what's kind of happening in the commodity space, just because what we do in Australia is we dig up the continent, we ship it to China. That's the Australian business model. And this Aussie dollar strength has basically been a result of the inward investment into Australia, into that commodities kind of model. And then overlaid on top of that is what I've done is put the difference in M3 growth between the Australian economy and the US economy. So not going to go into a lot of detail. M3 numbers are no longer published by the Fed, but they are recreated in the US by a couple of very good sources, and so just because the Fed don't publish the numbers doesn't mean they're not available. So just go hunting around the internet, you'll find M3 kind of proxy numbers there. They're still published in most of the other kind of developed economies, and certainly the RBA, the Reserve Bank of Australia, still publishes them on a monthly basis, and so they're interesting to look at. Well, what I've done here is just taken the difference in the growth rate of the money supply, the M3 money supply in the two different countries, and plotted that on in blue. And when the line is rising, when the blue line is rising, that means the money supply in Australia is growing faster than the money supply in the US. And what's interesting about this chart is it leads the Aussie dollar by a good 6 months. And you can see this kind of rise in the difference in money supply kind of echoed or predicted this advance in the Aussie dollar, and then the sell-off in the difference in money supply, kind of showed the signaled the decline in the Aussie dollar here. This rise here is also nicely signaled. The bottom in the market here, where we had money supply, the blue line is moving before cuts into the Aussie dollar line, and tracks a good 6 months, almost a year in advance of this kind of move going up. Then mirrors these kind of changes here, the sell-off here that we had. This was kind of the rush to, so that the global financial crisis and the rush into the US dollar led to a decline in the Aussie dollar back down to kind of 60 cents here. But you could see it in the money supply numbers 6 months prior. And then this last advance from 60 cents to $1.10 has been mirrored by the money supply kind of growth. However, over the last 6 or 9 months, you can see here this money supply difference line has come off quite dramatically. Now, all of this is counter to what economists will tell you will happen with the money supply and FX. So, if you've got the money supply growing faster than GDP, that means you're devaluing your currency, and these growth rates in money supply numbers in the Australia have been in the teens. So, money supply has been growing at 10 to 20%. Kind of on an annualized basis, and I can tell you that the GDP growth in Australia has been nothing like that. We've been lucky to get 4.5% GDP growth over the last 10 years. So we've been growing the money supply in Australia a lot faster than GDP, which would suggest, an economist, a classical money supply kind of Milton Friedman kind of economist would tell you, if you're growing your money supply faster than GDP, you're devaluing your currency, so your currency is going down. And we've had the exact reverse of that. Currency has actually doubled in value while we've been doubling the money supply and doubling it faster than GDP growth. And then when I look at the US numbers at the moment, money supply growth in the US is basically 0% right now. And a lot of economists are trying to say, well, dollar index is kind of falling through the floor, and yet money supply in the US is actually about 0%. Year-on-year growth is almost 0% at the moment. Yes, the Fed's created a lot of money by allowing the banks to put in over, I think it's about $1.5 trillion of reserves on the Fed balance sheet. So that's money just sitting there that the banks are not accessing. They're just earning an interest rate spread on that money to repair their balance sheet. But none of that money's kind of flowed into the economy in terms of additional lending to the business sector. Yes, we have the US government debt at whatever the deficit number is, over 10% of GDP, and at least half of that is being monetized by the Fed at the moment, and so effectively that's kind of new money that's being flowed into the economy, but it's only just kind of making up for the deleveraging that's happening in the private sector, and both on household and the business kind of balance sheets, with deleveraging going on. No one's borrowing money of any consequence, certainly nothing like we were seeing going on in 2005, 2006. And to be honest, I mean, I found all this stuff. I found all the money supply analysis and the components of GDP and inflation analysis and so on, and particularly the story on how you create hyperinflation and so on. I find all of this absolutely fascinating. But with the exception of this one chart where I see kind of a useful use of money supply kind of statistics for forex long-term forex kind of trading. I've found nothing that would help me kind of predict what the stock market's kind of going to do going forward. It just kind of leads me back to Paul Tudor Jones type conclusions, which is the price chart, the volume and price analysis is the absolute key here, and the fundamentals kind of follow that. So you've got all the information that you need, and you can avoid all the information overload by just looking at the price chart and seeing what's going on there. And as I said, I find the analysis kind of fascinating to be reading all the different opinions on what's going on, because we are at an extraordinary juncture in time. What the Fed is doing is revolutionary. Whether it will cause a revolution, I don't know. But we'll look back over the next. I don't know when the jury's going to be out in terms of what's happened in Japan. And the jury's out as to what the success have been to the changes that the Bank of Japan have done over the last 20 years. So we won't know the end result of this for literally decades. So being able to call it, for my day trades or swing trades is, an exercise in futility. But I'm still fascinated by what's kind of going on. Will probably kind of continue. But the net of all of this is to say, be well informed, have an interest in what's going on, have an opinion in what's going on. Check the other markets, the multi-markets. What's going on in gold and silver is extraordinary, and what's happening to the US dollar is extraordinary. But it doesn't help you kind of make your day trades, doesn't help me kind of make my weekly profit target. So that's kind of the story that I got out of all of this. I'll still continue to comment on these things and post these charts up, but it won't be kind of impacting, or ought not to be impacting what I do in my day-to-day kind of trading. So there we go, just a little bit of snippet. I hope you kind of enjoyed that. If you've got kind of an interest in the forex kind of markets, I think let me just kind of go back to silver and see where we're down at silver. So we're down at kind of 43 on silver in the pre-open. So interesting move. I don't know what's leading this kind of sell-off. Check the news feeds and what's happening. Yeah, we do live in an interesting kind of point in time. Hope you're enjoying your weekend, and looking forward to a decent week's trading next week.